4 years, silver has been treated like a controlled experiment, kept within boundaries, restrained by invisible hands, and capped at levels Wall Street swore would never break. Every rally was sold. Every surge was smothered. The message was always the same: this is as far as it goes. But markets don't move on promises. They move on pressure. And today that pressure finally snapped. What you're about to hear is not hype, not speculation, and not wishful thinking. It's a financial chain reaction, one that exposes how fragile the system becomes when math, leverage, and fear collide. This isn't just a price move. It's a structural event. Let's walk through exactly what just happened, and why it matters far more than most people realize. The barrier is officially broken. 4 months, the financial establishment repeated the same mantra. $65 was untouchable. It was the ceiling, the final line of defense. Banks, analysts, and institutions insisted they would protect it with every paper contract at their disposal. But today, Wednesday, December 17th, the market delivered its verdict. And it wasn't subtle. Silver didn't politely test $65. It obliterated it. Earlier today, silver surged as high as $66.50. As I'm speaking to you now, we've seen a modest pullback to around $65.80. And I already know what's going through your mind. You're staring at that retracement. You're watching the price slip from the highs. And that familiar voice of doubt is creeping in. Was that the top? Is this another fake breakout? Stop. Take a breath. Listen carefully. What we're seeing right now is not a failure. It's not a crash. It's not weakness. It's the single most important behavior a market can display after a breakout. It's called a retest. In this deep dive market update, we're going to dissect the anatomy of this move. We'll explain why silver exploded from $64 to $66.50 in a matter of moments. We'll break down the gamma squeeze that forced banks to buy against their will. And most importantly, I'll show you why this pullback to $65.80 is actually constructive, not bearish. If silver had continued straight up without pause, it would have collapsed under its own momentum. Instead, the market is testing its footing. It's reinforcing the foundation. The wall at $65 has fallen, but now comes the real test. Can it hold as support? This is the story of the breakout. To understand how silver seemed to teleport higher this morning, you need to understand the plumbing beneath the market. Specifically, you need to understand gamma. Gamma is an options term. It measures how rapidly a market maker's risk changes as price moves. Think of market makers as the casino. They sold enormous volumes of call options at the $65 strike, bets that silver would rise. As long as silver stayed below $65, those bets expired worthless and the house won. But the moment silver crossed $65, the math flipped, and it flipped violently. At around $65.10, risk systems lit up. Computers weren't concerned, they were alarmed. To prevent catastrophic losses, algorithms began buying silver futures automatically. Not because they wanted silver, but because they had no choice. Here's the trap: their buying pushed the price higher, which increased their risk, which forced them to buy even more. That feedback loop drove silver to $66. Then $66.50. This is a gamma squeeze, the same mechanical process that sent GameStop to $400 in 2021. It has nothing to do with fundamentals, mining supply, or industrial demand. It's pure mathematics colliding with leverage. This morning that math broke the banks. The spike to $66.50 wasn't enthusiasm, it was panic. There were no sellers. Just machines scrambling to cover exposure in a vacuum. So why did it stop? Why did we pull back to $65.80? Because humans stepped in. Traders saw a vertical price move and locked in profits. The forced buying exhausted itself, and price returned to something resembling reality. But here's the key point: the damage is already done. $65 has been breached. The psychological barrier is gone. And the market makers know it. Now let's talk about $65.80. To an amateur, dropping from $66.50 looks like weakness. To a professional, it looks like confirmation. There's a golden rule in technical analysis. Old resistance becomes new support. 4 months, $65 was a concrete ceiling. Every rally died there. Today we punched through it, and now we're standing on top of it, testing its strength. This pullback is the market checking the floor. If silver holds above $65 into the close, it sends a powerful signal. $65 is no longer a selling zone, it's a buying zone. That's how trends are born. But I need to be clear, this is the danger zone too. If silver closes back below $65, especially near $64, that would be a fake breakout. And fake breakouts often end brutally. This $65.80 area is a battleground. We still need confirmation. Now let's address the elephant in the room, the whale. Remember the massive buyer who absorbed roughly $650 million worth of silver around $63? Many wondered if they sold into the spike. I've been watching the order book all morning, and here's what I can tell you with confidence. They're still here. When silver dropped from $66.50 to $65.80, huge block bids appeared around $65.75. Someone stepped in and said, "I'll take it." That tells us something critical. Last week, smart money thought $63 was cheap. Today they think $65 is cheap. That's not profit-taking behavior. That's defensive accumulation. They're building a floor. They're protecting the breakout. Because they know what comes next. If $65 holds, the next targets aren't $66, they're $70, then $85. This is base building before the next advance. So don't look at $65.80 as a loss. Look at it as consolidation. Look at it as ammunition being reloaded. The gamma squeeze was the spark. The retest is the fuel. But the real fire comes from the short sellers. For decades, bullion banks like JP Morgan and Bank of America have suppressed silver by selling paper contracts. But at $66.50, those shorts became catastrophic. Losses went from manageable to existential. And now we're hearing persistent, though unconfirmed, rumors that a major U.S. commercial bank began closing its short position this morning. In part 2, we'll dissect that capitulation. We'll run the numbers. We'll explain why short covering is the most bullish force in any market. And we'll calculate exactly how much money the banks may have lost in just a few hours. The breakout has already happened. Now the panic begins. Stay tuned. In part 2, we're counting the bank's losses. Assume this is their last stand, their final attempt to manufacture liquidity so they can slip out the back door. Unless silver decisively breaks below $61.50, the trend remains intact. Capitulation is not a moment. It's a process. And right now, the banks are stuck inside a paper nightmare of their own making. They are bleeding billions. They are scrambling to cover. But while they shuffle contracts and play accounting games, the physical world is running out of patience. The surge to $66.50 wasn't driven solely by gamma mechanics or short covering. That was only part of the story. The deeper force was real-world desperation, industrial desperation. And that's where we go next. In part 3, we leave Wall Street behind and step into Main Street. We expose the physical disconnect. We examine growing reports that major industrial buyers are now paying $70 per ounce, not because they want to, but because they must. We'll look at the dealer market, where premiums are rising even as spot prices pause. The paper market is failing. The physical market is taking control. Stay right here. We need to talk about the $70 secret. If your entire worldview comes from a ticker on CNBC, you're missing what's actually happening. You see $65.80 flashing on a screen and assume that's the value of silver. It isn't. That number represents a paper promise, a contract that says silver might be delivered somewhere in New York at some point in the future. Now close the screen. Pick up the phone. Call a refiner. Try to source a monster box of Eagles. Suddenly you're living in a different universe. Here's the truth. While banks fight to keep the paper price under $66, industrial users are quietly paying $70 or more just to guarantee delivery. This is the shadow price. It's what Samsung pays to keep production lines alive. It's what the US Mint pays to secure blanks. And long-term, it's the only price that matters. The paper market is a warped reflection. The physical market is the object itself. And right now, the object is moving far faster than its reflection. So why would an industrial buyer pay $70 when the screen says $65.80? Because reliability is priceless. Imagine you run a solar panel factory. Your assembly line costs $1 million an hour to operate. If silver paste runs out, the line stops and millions evaporate instantly. Your supplier gives you a choice: $65.80 delivery in 3 weeks. Or $70 delivery today from emergency reserves. You don't hesitate. You pay the $70. Across the supply chain, this exact scenario is playing out. Electronics manufacturers are bypassing exchanges entirely. They're dealing directly with miners and refiners, offering cash bonuses to jump the queue. This creates a parallel market, one that doesn't show up in COMEX volume bars and doesn't immediately affect spot prices. But it drains physical inventory at an alarming pace while banks trade paper back and forth to manage optics. Eventually the disconnect snaps. When the exchange can't deliver metal, the paper price must leap upward to meet the shadow price. That's when silver gaps $5 in a single morning. We are standing inside that gap right now. The screen is lying. The invoice is telling the truth. Now let's talk retail, your world and mine. Visit any major online dealer today. Look at the premiums. Normally, fast price rises compress premiums. Dealers want to move stock. But not this time. Spot is up and premiums are climbing. What? Because dealers are terrified they can't replace inventory. They sold coins yesterday at $63. Today, restocking might cost them $65 or more, if they can even find supply. Their capital is under pressure. So they widen spreads. They post $65 spot plus a $10 premium. Or worse, they switch to pre-orders. Ships in 4 weeks. Translation: we don't have the silver. They take your cash today and hope they can source metal later. You've just given them an interest-free loan. If silver runs to $80 in 2 weeks, that order might get canceled. You get your dollars back but you miss the move. This retail inventory squeeze is the canary in the coal mine. When dealers stop selling, wholesalers have stopped selling. When wholesalers stop selling, refiners have stopped selling. The system begins to seize. So when you see $65.80 on a screen, do not assume you can buy physical silver at that price. The real entry point today is closer to $75 or $80. The discount window is already closed. Now we arrive at the ultimate systemic risk. We've talked about industry paying $70. We've talked about retail paying $80. But what about paper holders, ETF investors, unallocated account holders? They own contracts that promise silver. But buried in the fine print is a clause. In the event of market disruption, settlement may occur in cash. We are approaching that trigger. If the shadow price is $70 and spot is $65, it's cheaper for banks to hand you $65 in cash than buy $70 silver to deliver. Default becomes rational. If cash settlements begin, trust evaporates. Investors rush into physical. Premiums explode. This is the doom loop for fiat pricing. Shortage premiums, cash settlement, panic buying, higher premiums. We are in the opening phase of that loop now. The $65 breakout was the signal. The inability to source metal at that price is the confirmation. Paper holders are betting the system holds together. Physical holders are betting it doesn't. Judging by today's spreads, the system is already cracking. We've covered the technicals, the bank losses, the physical disconnect. The math is on our side. The geology is on our side. Industry is on our side. But one enemy remains, your own psychology. The coming days will test you. Volatility will spike. Headlines will turn frightening. Banks will try one last shakeout before prices go parabolic. In the final part of this series, I'll give you the mental armor to survive it, the price targets for the week ahead, and the strategy to ensure you don't sell a winning lottery ticket for the price of a coffee. The wall is down. The field is open. Don't stumble at the finish line. Today, Wednesday, December 17, 2025, marks the end of an era. Cheap silver is gone. Managed prices are gone. We have entered price discovery. And price discovery has no map. $65 isn't expensive. Adjusted for inflation, silver's 1980 high equates to roughly $170 today. At $65, silver is still trading at a massive discount while every other asset class sits at all-time highs. Silver isn't in a bubble. The dollar is. The final lesson is simple. You don't sell for cash. Cash melts. You swap. When silver becomes overvalued, you exchange it for gold, land, or cash-flowing assets. Watch the gold to silver ratio. When it collapses, that's your exit. Trade ounces for acres. Trade volatility for permanence. We'll look back on this day as the moment control was lost. The genie is out of the bottle. Scarcity is no longer theoretical. And you're already seated at the table. Do nothing. Hold steady. Let the market come to you. The squeeze hasn't peaked. It has just begun.